I own Bitcoin as a savings technology. It's the greatest savings technology I think the world has ever seen, because in normal savings, right, you put your money in the bank and you put it in a low risk asset to save it. And every day the government steals part of it back from you through this thing called inflation. That's a crappy system. It's theft. Then what do? Well, I would invest it. Okay, well, if I want to invest, I have to take some risk. I have to take equity risk or credit risk or innovation risk, and I can get a higher return. But the nice thing about Bitcoin as a savings technology is I can take it off grid, out of the system, and save it. And every day that government creates inflation to steal my wealth from my fiat, I get an increase.
To illustrate the unique nature of Bitcoin, Yusko revisits March 2020, a period that will be remembered for its rapid market collapse amid the initial COVID-19 panic. In just a matter of days, global markets fell sharply, and Bitcoin dropped 50% in only 12 hours. Many observers at the time interpreted this as evidence of Bitcoin being tightly correlated to traditional assets, but Yusko disagrees. He explains that during such extreme market events, all correlations tend to spike temporarily. The initial decline was largely a result of forced liquidations. Investors holding stocks on margin were hit with margin calls and had to sell their most liquid assets to cover losses, including cash, bonds, gold, and Bitcoin. This forced selling, however, was short-lived, as Bitcoin quickly rebounded, highlighting its independence from traditional market dynamics once the immediate panic subsided. Before we go on, just a quick reminder: liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support. Let's continue.
Go back to 2000. So remember 2000. The world goes crazy. They run this drill and say everybody locked down, and the markets collapse. And Bitcoin fell 50% in 12 hours, right? 50% in 12 hours. Everybody said, see, it's totally correlated. I'm like, no, it's not correlated at all. And within a very short time, Bitcoin was back, and it took stocks a while for them to, print the money and start the rally. But Bitcoin bounced back really quickly. Why? Well, when you get a margin call, right? If you own a bunch of stocks and you have borrowed against them and you get a margin call and the stocks are down, well, you can't sell the stocks. So you got to sell what's not down. Well, what's not down? Cash, gold, bonds, Bitcoin. So all of those things fell in those first couple weeks of March in 2020, just like stocks. And everybody said, see, correlations are one. Like, well, duh, in a crisis, all correlations go to one. But then something interesting happened is they diverge. And bonds went back up and Bitcoin went back up. And if you bought that $5,000 bottom, that was a pretty good buy in March of 2020. Same thing with oil stocks. Everybody thought, oil price went negative in April for a couple, hours. Crazy. You had to pay people to take your oil. So long story is, ultimately, I think the same thing will happen if we get an unexpected decline and a deleveraging. People will be forced to sell Bitcoin, gold, whatever, and pay their margin calls. But the difference is, I don't believe Bitcoin is a risk asset. I don't believe that people that own it to speculate like they do NVIDIA or Microsoft or other tech stocks. I own Bitcoin as a savings technology. It's the greatest savings technology I think the world has ever seen, because in normal savings, right, you put your money in the bank and you put it in a low risk asset to save it. And every day the government steals part of it back from you through this thing called inflation. That's a crappy system. It's theft. Then what do? Well, I would invest it. Okay, well, if I want to invest, I have to take some risk. I have to take equity risk or credit risk or innovation risk, and I can get a higher return. But the nice thing about Bitcoin as a savings technology is I can take it off grid, out of the system, and save it. And every day that government creates inflation to steal my wealth from my fiat, I get an increase. Now, it's a similar thing with real estate. I use the example of my house, right? According to Zillow, my house is worth twice as much as it was 5 years ago. My house didn't grow. It didn't get more efficient. In fact, it actually wore out a little bit. I had to put money back into it. So it really didn't appreciate. What happened is the money got worse. We've printed 80% of all the money in the United States. We've been a republic for 249 and a half years. 80% of all the money in that 249 and a half years came in the last 5 years. Crazy. So we've devalued the currency by a lot. That's why gold's up. It's why silver's up. It's why Bitcoin's up. It's why houses are up. Because as we devalue the base currency, the asset that you own that has to be denominated in something, like use gold. 1 ounce of gold has been 1 ounce of gold for 5,000 years. Hasn't changed, right? But the value of that 1 ounce of gold has changed. It's interesting. It's been exactly the same for 5,000 years, meaning 5,000 years ago, you could give someone an ounce and you got a fine person suit. Today, you could give someone an ounce and you get a fine person suit. It's really quite interesting. Now, Bitcoin, 1 Bitcoin's 1 Bitcoin, but we don't price Bitcoin in Bitcoin. We price it in dollars or yen or euros. Let's take today. So today people cry, oh, you should have bought Venezuelan stocks on last Friday before the thing happened. Oh, okay. So you bought Venezuelan stocks, but yes, Venezuelan stocks are up 75% in like 3 days, but the currency's down like 99.9%. You actually lost money. And in fact, in my office in the other part of the house, I have a 100 trillion Zimbabwe dollar bill. Like literally 100 trillion, lots of zeros. It wouldn't buy a loaf of bread. So I'm a trillionaire in Zimbabwe, but I couldn't buy a loaf of bread because the value of the currency goes down so much. In fact, there's no time in history where you want to have your market be the best performing market parabolically, because that means your currency is getting cremated. It happened in Argentina, it happened in Zimbabwe, it happened in Venezuela, it happened, in Turkey. You don't want to be a Turkish billionaire because your currency is down 98%. So the same thing is true here. Is I believe Bitcoin is a different use case. It's a better form of money. Money is an asset that exists in the absence of a liability. There's really only one. I mean, there's two, silver and gold. But gold is really the core. Silver is kind of secondary. Bitcoin is a better form of gold. It's equally scarce and it's more portable and more divisible. Simple example. If I had a bar of gold, which, maybe I have one lying around somewhere, but if I had it right here, I'm not strong enough to break it in half. I'm just not. Even if I could break it in half and try to send you half, I couldn't stuff it in my computer, right? But I can pick up my phone with a couple buttons. I can send you Bitcoin instantaneously. It's just a better form of money. And money is different than currency. Currency is backed by fiat, backed by debt, and governments like it, and it's a perfectly good thing, and we live based on it, but it's fallible in that it can be taken away from you. And it is taken away from you every single day, whether you live in Australia or, US or Europe, it doesn't matter. The governments are taking it away by printing more of this to fund their spending habits. So I will argue Bitcoin in the short run might go down, but over the long run, the response to that type of market correction will be more money printing, which means more value accreting to Bitcoin.
Yusko dives deep into the technical and cyclical aspects of Bitcoin. He highlights how the market reacts to institutional participation, futures markets, and macroeconomic liquidity conditions. For example, while institutional inflows into Bitcoin are bullish, much of this buying is offset by short positions in futures markets, creating complex dynamics that can suppress price growth. He references historical patterns, such as the correlation between the introduction of CME Bitcoin futures and major market peaks, demonstrating how large players can effectively tame price movements. This manipulation is not necessarily malicious, but is a structural feature of commodity-like markets where futures and spot prices interact.
The fair value, right, from Metcalfe's law has to do with the number of nodes, the number of transactions, the transaction size. So the actual usage, the growth of the Bitcoin blockchain network. And that number is determinable. And you can look at Tim Peterson's website and he'll tell you what it is. And that number will increase over time. Now, it tends to be impacted clearly by things like interest rate cuts and global liquidity. So look, China is increasing money supply. That's a positive. That will be offset a little bit by, we have two phenomena that happen around the early part of the year. One is Chinese New Year. So we get a little negative impulse every Chinese New Year because people in China need to fill up the red envelopes with money. So they sell some Bitcoin, and that puts a little pressure on. The second one is around tax day in the US in April, where if you've had a good year the previous year, you get some weakness. And we saw that really in 2025. 2024 was such a good year that people had to pay a lot of taxes. So we saw a big drop in April before we made that final spike to the high at 126 over the summer, which was the normal pattern for a 311 cycle. So I think where we are today is, your point is exactly right, that institutional interest has ramped up. The problem is it's not all accumulative. What I mean by that is everyone reports on, this big hedge fund bought $2 billion of IBIT. Yeah, but they're short $2 billion of futures against it because they're a market neutral hedge fund. They don't go long things. They take advantage. They carry trade. And it's really not such a carry trade like the Japan carry trade. What it is a futures roll yield capture. So the futures price is always higher than the current price because people are optimistic, right? So when the future, well, it's not always, but generally speaking, it's higher. You can have commodity markets invert, but most times the futures price is higher and it rolls down the curve over the course of the month. So there is a return, a riskless arbitrage to capture if you short the future and go long the spot. And it happens in all commodity markets, whether it's corn or oil or gold. The problem is, remember when Bitcoin was deemed a commodity and everybody cheered because it wasn't a security? I'm like, be careful what you ask for. You might get it. That was not random. That was not unplanned. That was specifically designed to allow what's happening now, which is when you deem something a commodity, the big dogs can make a lot of money on this roll yield trade, and they can spoof the price. That's been happening in the gold markets and the silver markets for a long time, where the big guys like JP Morgan will short as much as they can against the long, whether that long was an ETF or whether it was other producers like gold miners or silver miners. And so what you'll see over time is the price tends to be stuck in this range. Remember when GLD started and everybody said, there's going to be this demand for gold and gold price is going to go up. It didn't go up. It actually just stayed flat. And same thing with silver. It stayed flat. Well, then what happens, and everybody says, but gold rallied a lot last year, or silver's rallying a lot. Yeah, because what happens is once the people who are short get squeezed, right, the price starts to bump up against where they're short, and suddenly they have to cover, you get a parabolic squeeze. We saw that in gold last year in August, where there was a big short squeeze, went from 3,300 all the way to 4,400. We're seeing in silver right now, like every day, silver's up another 10%. And because shorts, there was a report, I don't know if it's real, but the JP Morgan had been short about 2 times global silver production. That's a big short. And they were having to cover. There was an argument that they were out of business. I don't think that's true, but I think they lost a lot of money. And one of the challenges of Bitcoin is this same phenomenon, is as great as it is to have people buying the ETF or institutions buying spot, the problem is the future. And it's not a coincidence that literally to the day in 2017, December 18th, was the day the CME released futures was the peak. It's not a coincidence that November 6th, 21 was the peak, the day the CME increased the options on futures. So that isn't a coincidence. And there's a very famous interview by this guy, Leo Melamed. He was the former CEO of the CME, Chicago Mercantile Exchange, and now he's chairman emeritus. And he said in 2017, I thought it was a very interesting word. He said, don't worry, we'll tame Bitcoin. Tame? That's a funny word, right? Why are you using that word? Well, he was right. The big dogs can hold the price down. And so I would not be surprised at all if we just stayed in this kind of funky zone, whether it's 85 to 100 or 75 to 95, I don't really know, but stayed in this zone and the spoofing just keeps happening. But at some point later this year, we break the ceiling and we get into a parabolic short covering rally. That wouldn't surprise me. I was looking at the consensus for Bitcoin prices, and I think the consensus, again, as it usually is, just like stocks, is bullish. And people want to say that the 4-year cycle is dead and that, it's up only and we're going back to the moon and all this good stuff. I'm struggling. So, I was on record a year ago in January, which was not very popular, saying that the 4-year cycle was alive and well, and actually that it wasn't a 4-year cycle. It's actually, I call it 3.11. It's 3 years and 11 months. And that's because it's based on the number of blocks, not on a calendar. And so, December of 2017, November 2021, October 2025, that cycle has played out exactly as we would expect. And it didn't get quite as high in terms of, I thought we'd peak at around 150-ish based on, and the logic was that in the previous cycles, 17 and 21, we got to 2 times fair value. So fair value is determined by the Metcalfe's law model that Tim Peterson and others run. And so in 2017, fair value was 10. We got to 20 before we crashed all the way back down to 3. Then in 21, fair value was 32, 33. We got all the way to 69. Now, why do we get so much above fair value? Humans are going to human. We get greed, we get, leverage. And when leverage is abundant, you can get very much above fair value. And that's why you then need a big crash. Because when you start the crash, in theory, if you're 2 times above, you only need a 50% correction to get back to fair value. But markets aren't that precise. They crash right through fair value and then go to the depths of despair. So long story short, in this 311 cycle, we get about a 360-day period that is crypto winter. And crypto winter lasts from the peak to, the next year. And in the 17 and 21 cycles, we had about an 84% drop and then a 74% drop. I argued that this time we were only going to get to about 50 to maybe 60% above fair value because there was less leverage. They'd taken some of the leverage out of the system. We didn't even get that far. We only got to 125. So we only got to about maybe 35, 40% above fair value being around 91. So long story short, the correction needed to be less. And so from 125 all the way down, I think we hit 80 at some point. That's a pretty meaningful correction. That's below fair value. So could we be stuck in this meandering range for the duration of the crypto winter, which would come sometime, September-ish, August, September-ish of this year? Yeah. So whether we stay in a range between 80 and 100 or 80 and 95 or 75 and 105, I don't really know, but I think that's possible. And so while it's certainly bullish when prices recover and rise, I don't see the momentum that you need to push back into a bull market until we clear out some of the tourists, I guess, the tourists who come in and lever up.
That's it for today's deep dive into Mark Yusko's Bitcoin insights. If you found this analysis helpful, don't forget to like, subscribe, and hit the notification bell so you never miss our expert market breakdowns. Drop a comment below with your thoughts. Do you agree that Bitcoin is the ultimate savings technology, or do you think its role as a risk asset is underappreciated?